Is everybody on?
It looks like we're all here.
Okay.
Good morning. Thank you for joining us today for the third in a three-part series of webinars hosted by Weingartner Law Firm. We're focusing on keeping assets under management. So we've invited a lot of financial professionals to join us and kind of continue have an ongoing conversation about ways that are helpful for you to keep assets under management and thereby helping us as estate planning attorneys to help your clients keep assets under management and make sure that their money's working for them. And today we're going to talk about the new tax law. It is of interest to a lot of people. Lisa's going to go through some of the highlights that she finds interesting and share some ideas and thoughts about how tax planning is affected by the new tax law. So with that, I give you Lisa.
Good morning, everyone. Thanks so much for joining us today. Happy Friday. Like Jennifer said, we are here to talk about the new tax law. We are going to name it. We're going to talk about some individual changes. We're going to talk about for individual taxpayer changes, some estate and gift tax changes, and then what this means for us in our field going forward. So the new tax law's actual name is to provide for reconciliation pursuant to Titles 2 and 5 of the concurrent resolution of the budget for fiscal year 2018. But there's a decent chance you haven't ever heard anybody call it that besides this morning. We call it the 2017 Tax Cuts and Jobs Act. Some people call it the 2017 Tax Reconciliation Act, the Reconciliation Act of 2017. What you need to know is that this is the 2017 Tax Act. It was signed into law on December 22nd, 2017. And for most of the provisions in the new law, the new law goes into effect on January 1st, 2018, and it's scheduled to sunset on December 31st, 2025. But again, that is for most provisions. Not all of them fall into either the effective date or the date when this ceases, the sunset date. One of the biggest highlights to run over with you today is the new format for individual tax filers. The 1040EZ will now be on a postcard-sized piece of paper, front and back. Of course, for most of your clients, they will still be receiving schedules. They'll still be returning schedules. You'll still be sending them 1099. But for some people, this will be a big simplification for how they do their individual income tax. Another big highlight here is the change in rates. And you'll see we have the 2017 tax rates versus what is set to be the rules for 2018 through 2025. You'll notice when you look at this graph that the top line, which is actually the lowest income tax, lowest income people, has not changed at all. It did not go up, it did not go down, it stayed where it was in 2017. You'll see that most went down, but if you go all the way to the bottom to the highest earners and then go up one to the next to last bracket, you'll see that it actually went up for these individuals that fall into this bracket. A few more of the highlights that we have for you. The standard deduction. So the standard deduction for 2018 nearly doubled what it was in 2017. For individuals, the standard deduction increased to $12,000 from what it was in 2017, $6,350. But what the big print giveth, the small print taketh away. The personal exemption has been removed. However, for clients of yours, this will still be a net gain because the personal exemption amount was always lower than the standard deduction. So nearly doubling the standard deduction and removing the personal exemption still remains a gain for most taxpayers. The deduction for married people filing jointly likewise nearly doubled from the year 2017. it went up to $24,000 from where it was in 2017 at $12,700. So while the standard deductions have increased, the miscellaneous itemized deductions have been severely curtailed. One of the big ones that you'll see affecting your clients is the limit on mortgage interest deductions. That has been reduced, but you should know that mortgages that are already in place before this new law went into effect for this provision, which was January 1st, 2018, those old mortgages will be grandfathered in and they won't suffer that reduction in deduction. The threshold for deductibility for medical expenses has been decreased from 10% of an individual's adjusted gross income to 7.5% of an individual's adjusted gross income. So that might be helpful for some of your clients. Another big thing that this new law did was it repealed the Obamacare healthcare mandate, and it removed the subsidy. However, the repeal of the mandate and the removal of the subsidy did not go into effect on January 1st, 2018. They will go into effect on January 1st, 2019. So most itemized deductions, like we said, have been eliminated. Some of them have just been curtailed. One of the interesting ones, I think, and your clients may agree, is that the alimony deduction has been removed. And this, like the Obamacare removal of the mandate, did not go into effect on January 1st, 2018. It begins on January 1st, 2019. Now we're going to move on to the transfer taxes versus the individual income taxes. And one of the biggest things that this new law did, the 2017 Tax Cuts and Jobs Act did, was it almost doubled the lifetime unified gift and estate tax exclusion. It went up to $11.18 million, and that is the basic exclusion amount. That is what you can either give away during your lifetime or die owning. Up to $11.8 million will go tax-free to whomever you'd like it to go to. Another transfer tax is the generation skipping transfer tax. And this basic exclusion is unified with the lifetime basic gift and estate tax exclusion. It is $11.18 million. And an easier way to think of that is $11.2 million. You'll hear that a lot. The annual gift tax exclusion amount, and this is the amount that you can gift to people without reducing your lifetime unified basic exclusion amount, is $15,000 per donee. And for the gift and estate tax and for the annual gift tax exclusion, of course, if you are a married couple and you want to jointly gift, or you want to take advantage of the marital deduction for estate tax, you can basically double these numbers as well. So we've doubled it from 2017, and if you're married and you fill out all the documentation properly, you can double that as well. This law, like all of the laws that we've been talking about, is scheduled to sunset at the end of 2025. On December 31st, 2025, these numbers will cease to be, and on January 1st, 2026, we'll go back to the 2017 basic exclusion amount adjusted for inflation. So this causes some concern. What does this mean then for people who gift based on the exclusion amount in place during their lifetimes if the exclusion amount at their death is significantly reduced? So the problem is laid out in A and B. The basic exclusion applicable at the time of the decedent's death versus the basic exclusion amount applicable when any gifts were made. And a lot of tax practitioners refer to this new section, the new tax law of 2017 added 2001 G2. And they call this the anti-clawback provision, the idea that they're going to claw back in gifts that were made when the exclusion was high to get that tax at your death when the exclusion is lower. This doesn't really answer the question. Instead, it's sort of been punted down the road, and we're expecting regulations to come out that should give us more guidance as to what will happen in that situation. It's not certain, however. As of today, there's been no regulations put forth. So what do we do? What do we do? What does this mean? What we know is that income tax planning remains important. The idea of basis adjustment remains important. Recall that gifts made during your lifetime for the donee will take the donor's basis. For gifts given at death, for testamentary gifts, the basis that the donee receives will be the fair market value of that asset received at the time of the decedent's death. So then you have to look at the numbers. What's the difference? And we're talking to Florida financial planners. So Florida has no estate tax, and Florida has no income tax. So here we're only worried about the federal rates. The maximum federal estate tax rate, and of course, again, that's for people who at their death have more than $11.8 million worth of estate, or, you know, adjusted for gifts made during their lifetime. The maximum estate tax rate is 40% for that above $11.18 million versus the maximum federal capital gains rate, which is 23.8%. And those capital gains would be incurred as a result of selling an asset at fair market value, something that you got as a gift during the giver's lifetime. You have that adjusted basis versus the fair market value. The difference would be a capital gain subject to capital gains tax. So what do we do? What do we know? We move forward. We move forward with income tax planning. We know what we know. And estate planning generally remains important. So estate tax planning for a lot of people is no longer of the ultimate significance that it once was, but general estate planning issues still remain critical. Every one of your clients still needs a healthcare proxy. Every one of your clients still needs a durable power of attorney. They still need wills. Perhaps they still need trusts. Something here to really consider as well for your clients that tell you they've already done their estate planning is formula clauses that have been written into wills and written into trusts. When I earned my Master of Laws in estate planning in 2006, the lifetime, the unified exemption amount was $2 million. So that's a far cry from what it is today at $11.18 million. And when people were writing wills back then and writing trusts, and they were very, very motivated to avoid estate tax problems, to avoid estate tax at their death, they wrote in formula clauses. And what it did then was it took advantage of all of the estate tax exemption and then either took advantage of the unlimited marital deduction or the charitable deduction. So what it would say is I leave everything to my spouse that I own above the basic exclusion amount. And that worked for people when there was a $2 million exclusion and they had $4 million. But today, if they have $4 million and there's $11.8 million, $18 million exclusion, they are disinheriting their spouse. They are disinheriting that charity. So it's worth looking at older testaments and older trusts to make sure that this is not a horrible situation waiting to explode for your clients. I thank you very much for your attention today. Have a great day. My information's here. If you want to talk any further, look forward to hearing from you.
Thank you, Lisa, and thanks everybody for logging in. Of course, we're going to put this up on the website so you can share it with your clients along with the PowerPoint. Stay tuned. We have more coming down the road, and we'll make sure that everybody's informed, and just watch your email. Thanks again.
Thank you.